Want to evaluate a company within 30 seconds? You are in the right place. Most investors think a low PE means a stock is cheap. It doesn't. And sometimes a high PE is exactly what you want to see. Today, I want to walk you through 3 valuation ratios that, when used correctly, can quietly tilt the odds in your favor. The PE ratio, the PEG ratio, and Peter Lynch's refined version, often called the PEGY ratio. This isn't about memorizing formulas. It's about understanding what the market is actually pricing in. Let's start with the price to earnings ratio. The price to earnings ratio is straightforward. You take the stock price, divide it by earnings per share. If a company trades at $100 and earns $10 per share, the PE is 10. You're paying $10 for every $1 of annual earnings. Simple. But here's the issue. A PE ratio tells you what you're paying today, but it tells you nothing about tomorrow. Two companies can have identical PEs. One could be shrinking, the other could be compounding earnings at 25% annually. Same price tag, completely different future. That's where growth enters the equation. The PEG ratio takes the PE and divides it by earnings growth. It was originally developed by Mario Farina, but it became widely known thanks to Peter Lynch during his tenure at Fidelity Magellan Fund, where he delivered extraordinary long-term returns. Here's how PEG works. If a company has a PE of 12 earnings growing at 12%, its PEG ratio is 1. If another company has a PE of 10 growth of 5%, its PEG is 2. Suddenly, the cheap stock doesn't look so cheap anymore. Lynch's rule of thumb was simple. PEG below 1 implies potentially undervalued PEG, above 1 implies potentially expensive. But even this misses something important, because investors don't just earn returns from growth, they also earn returns from cash distributions. This is where things get interesting. The PEGY ratio modifies PEG by adding dividend yield into the denominator. Formula: PE divided by growth rate plus dividend yield. Now, we're measuring how much we pay not just for growth, but for total shareholder return. Let's say a company has PE of 30, growth of 30%, dividend yield of 3%. PEGY equals 30 divided by 30 plus 3 equals 0.9. That extra dividend lowers the valuation relative to total return potential. Why does this matter? Because two companies can grow at the same rate, but the one paying you cash today reduces your reliance on perfect future execution. Dividends reduce forecasting risk. And in investing, reducing risk is often more powerful than chasing upside. What made Peter Lynch effective wasn't just ratios, it was context. He looked for companies where growth was durable, valuation wasn't stretched, dividends strengthened total return. He used this approach to identify businesses like early-stage Home Depot, Taco Bell, and Dunkin' Donuts when the market hadn't fully appreciated their trajectory. But here's the key. The ratio didn't make the decision. It narrowed the field. Ratios are filters, not conclusions. Here is a practical framework you can use when analyzing a stock. Step 1. Look at PE. Is it extreme relative to history or peers? Step 2. Calculate PEG. Is growth justifying the valuation? Step 3. Calculate PEGY. Are dividends improving total return dynamics? If PEGY is below 1, you may have something worth deeper investigation. But always follow up with balance sheet strength, competitive moat, industry structure, capital allocation quality, because valuation without business quality is speculation. The contrarian insight most people miss is that sometimes the market assigns a low PE for a reason. Declining industries often look statistically cheap. Meanwhile, high-quality compounders rarely trade at single-digit multiples. Your job isn't to find the lowest number. It's to find the best relationship between price growth, cash return, and risk. The PEGY ratio simply helps quantify that relationship. No metric guarantees success, but combining price, growth, and dividends into one disciplined filter prevents two common mistakes: overpaying for hype, buying cheap stocks that deserve to be cheap. If you build this into your screening process, you'll evaluate businesses more rationally and screen businesses within 30 seconds. And in long-term investing, patience compounds faster than excitement. If you want to systematize this process, use a simple calculator, plug in the numbers, and let the math do the filtering. Then spend your real time studying the business. That's how you build wealth the smart way. This is Smart Wealth Code. See you in the next one.